Welcome to this week's Money Market Update. You know, it's amazing. I'm sitting here watching the Masters this morning and watching Tiger Woods make this incredible comeback from, what was a life-threatening injury a couple of years ago at his first tournament back. He's 4 or 5 shots off the pace after the second round. There's so many similarities to so many things in life and investing. Endurance, making sure that you stick to the process, making sure that you just endure over time. And when you look at Tiger Woods and what he's been able to do over the course of his career and what great investors do, the process is not any different. The basics are the same. And when you're investing and you're putting your money into the market, one of the most important things is you consistently be able to follow that same process and not get distracted and not get deviated and think that I can do this and do that and try this and try that. When you look at the greats in golf and the greats in football and the greats in any endeavor, what they do best are the basics. What they do best is sticking to the process. And one of the things that is going to ensure your success over time is you sticking to understanding that the basics and the process are going to get you to the point of understanding what is going to consistently happen in time. Now, Tiger Woods made a decision to go to the Masters. He didn't know if he was actually going to play until the last day. So people are thinking, when is Tiger going to win again? Tiger's probably not going to win the Masters this time around. People get transfixed in investing on when is it going to happen? When is it going to happen? When am I going to make money? What Tiger Woods knows is what is going to happen in the course of the next 2 years, 3 years, 5 years. And what is going to happen with your investing is if you focus on the process, the outcome is over time assured. None of us know. Tiger doesn't know when he's going to win his next tournament. I don't know when I'm going to make my next dollar in the financial markets. But what I know is if I follow the basics, if I follow the process and I stick to that one thing, I'm going to do extraordinarily well over time. Time to get a top up and give you a wrap up of what's been happening in the markets this week. All right. So last time we chatted, I was talking about inflation and the importance of appreciating that the US Fed is going to raise interest rates and inflation is the big elephant in the room in 2022 as to whether or not share prices are going to finish the year on a positive or whether or not they're going to struggle this year. And you need to keep things in perspective. We've had 3 years of incredible gains of the S&P 500 on average rising close to 20% a year. Last year was 28%. The year before that was over 20%. And the year before that was about 18%. So it's been an extraordinary rally for 3 years. And what we're seeing right now is because of the massive amounts of stimulus central banks injected into financial markets, the low interest rates of 0% interest rates, what we've seen is the US Fed leave the pedal to the metal for too long and leave monetary policy loose for too long. I mean, I talked to my clients this week and I said, hey guys, have you ever actually seen a bushfire get out of control? Have you ever actually been as a kid on your skateboard riding down the hill and you get the speed wobbles and you stack it? Basically what's happening in the US right now is the economy is out of control. Americans are richer than ever. Growth is strong. Inflation is strong. There are millions more jobs available than people to fill those jobs. And what the Fed is now doing is putting the brakes on. We had 2 Fed committee members coming out this week saying, hey, we're likely going to need to raise interest rates potentially by even 0.5% instead of 0.25% in upcoming meetings. So what this has done essentially is it's spooked the market a little bit because, of course, if interest rates go up, and you've got to remember this, you might want to jot some of these things down. If interest rates go up, that means consumers and businesses are potentially going to spend less. We spend less when interest rates are higher. Credit card interest rates are higher. Mortgage rates or interest rates are higher. Things are a little more expensive on the credit side. So therefore people pare back their spending. Maybe a business doesn't borrow as much money. Maybe they don't hire as often new employees. So therefore the economy slows down. And what is the ultimate impact? The ultimate impact is that earnings at companies drop a little bit. So therefore what impacts share prices higher? It is earnings, profit from those businesses. Now, if we're going to see lower earnings, well, that needs to be matched up with the share price. So if a share price is really high and the earnings for those businesses are potentially falling, then there has to be a revaluation of the share price. And that's exactly what we're seeing right now in the NASDAQ, in the overly priced companies in the NASDAQ where the share price doesn't match the earnings. But what we are seeing are companies that are essential businesses. Even if we see a global economic slowdown in the next 12 months, and we're not going to see a recession at this point, but if we did see a recession in 2023, what are the essential businesses that are still going to be required and needed? Well, they're the businesses right now that are making all-time new highs, and all of the money that is coming out of the overpriced tech businesses is coming into businesses that are essential. Walmart, Costco, Coca-Cola, Berkshire Hathaway, a safe haven business. There's a cross-section of America with many, many essential companies. It's very obvious right now. Just look at your platform this morning and look up essential businesses. Grocery stores, supermarkets, beverage businesses, snack food businesses. People need to still eat. Walmart is the biggest supplier of fruit and vegetables and supermarket goods all across the United States. Its share price is continuing to rise. Costco is the same. And we are going to continue to see these money managers rotate money out of the expensive stocks into businesses that are going to see their earnings continue to be maintained. That is exactly what we're seeing going on right now. Now, if inflation starts to come down in the second half of the year, that money will flow back into those other companies that are now starting to see their share prices deflate in value. So here at Trading Mastery, one of the great things about our portfolio is we have a balance correctly. We have a balance of great quality tech businesses, and we have a balance of great quality essential businesses, and that is the reason why our portfolio is holding up so well. Over the course of the next few weeks, however, there is something coming up that you need to know about, and I'm going to get to that right now. You know, this coming week is going to be really the start. Here goes Tiger with a little chip shot. I think he's about 1 over, and I think the leader's about 4 under, so he's about 5 shots over the pace. This week, you need to be on the pace with company earnings. We're going to see banks start to issue their company earnings, and what we're going to be looking for over the course of the next couple of weeks as we lead into the really deep part of the first quarter earnings season is what are the earnings from the first quarter of all of the major businesses in the S&P 500. I suspect that they will be strong because the US economy through the first 3 months of the year has been performing very, very well. But what is going to be the key? What is going to be the key is what are the chief financial officers, the accountants, the board of directors and management saying about future earnings in the next 6 to 9 months. If the collective wisdom of these CEOs, CFOs, and these statements coming out over the next few weeks start to say, we are likely going to see an economic slowdown because of high inflation, we're expecting lower earnings in the next 6 months, then we're going to see a continued rotation and revaluation of those overly priced tech businesses where the share price doesn't match the earnings, and we're going to see more money come into the businesses, the essentials that I was talking about just a moment ago. I want to make sure I keep you up to date with what's going on over the course of the next few weeks, because it's important as an investor that you don't get stuck looking at charts and prices and you actually truly understand what's going on. I trust you have a great week in the markets, and I'll see you next week.